Hi everyone, this is Eric from Traders Helping Traders with this week's Tricks of the Trade. As traders, we're all very interested in whether or not a market's going to begin trending and who has control of the market, whether the bulls or the bears. Now, oftentimes, we're able to discern all this just from watching price action. But every once in a while, I'll flip over to an indicator to help me decipher what might be going on in the marketplace. The single best indicator for determining market momentum and who has control of the market is DMI and ADX. It's actually one and the same indicator. They were both developed by Wells Wilder, the same fellow who developed RSI. And while it's not necessary to actually use this particular indicator, I will dust it off every once in a while just to help me determine which side of the market I should be looking at. Now, when you first look at DMI and ADX, it can be a little bit confusing because it's a bunch of squiggly lines. And normally it's going to look like this. But what I've done is I've changed the one line to a dotted line so that I'll be able to show you a few things with this particular indicator. Now, the stock settings for DMI and ADX are usually a DMI for a period of 14 and ADX for a period of 8. Now, you know that when I set my periods on moving average, on indicators and moving averages, I tend to gravitate toward Fibonacci numbers. Don't ask me why. There's nothing magical about it, but if I'm close to a Fibonacci number, I'll throw a Fibonacci number in there. Well, 13 happens to be a Fibonacci number, so I've substituted 13 instead of the default 14. 8 is also a Fibonacci number, so I'll leave that one as is. What it does, too, is it helps speed up the indicator ever so slightly. DMI is a very, very slow indicator. Now, you might think that this is a bit of a detriment, and if you interpret it in the traditional sense, it very well might be. However, because it is such a slow indicator, it usually gets you on the right side of the trend. And, of course, that's what we're most interested in. Now, of course, if the market is very volatile and moving very quickly, well, then DMI and ADX, because they are such lagging indicators, won't really be generating a good signal. So always, always, always take what you see in an indicator, whether it's DMI or RSI or MACD or stochastics or whatever, and confirm it with what's happening in prices. That's very important, very important. If you take nothing away from this lesson except that is the most crucial bit of information when you are dealing with indicators. They must always confirm what is happening in the price panel. All right then, so how do we interpret DMI and ADX? Well, DMI and ADX are one and the same indicator displayed two different ways. ADX, this dotted blue line, is actually an average of the DMI lines. Now, DMI stands for Directional Moving Index, and you have two types of DMI lines. Here, the green line represents what is called positive DMI, or bullish price movement. This represents prices heading higher. Negative DMI is represented by the red line, and it represents prices going lower. Now, DMI and ADX are non-directional. What that means is that they don't really display in any specific correlation to what's happening to prices. But what DMI will tell you is that when the green is above the red, then the bulls have control of the market. When the red is above the green, then the bears have control of the market. DMI and ADX are plotted on a percentage scale from 0 to 100. And most analysts concur that if the ADX is rising and trading above 25%, then the market is considered to be trending. Now, some analysts will move it as low as 20%, and some will leave it as high as 40%. Personally, I think 25% is probably a pretty good dividing line. So what this tells you is that so long as the indicators, DMI, ADX, the positive and the negative, so long as they're below 25, you have a market that is ranging, a market that is not trending. However, once the indicators start to get above 25, first the DMI, because it's much more responsive, and then eventually the ADX, well, that shows you that you have a market that has begun a trend. And if you are a trend trader, which almost all of us are, because that's where the best opportunities lie, you'll be most interested when you see rising ADX, especially once it gets above the 25% region, as well as rising DMI. Now, the traditional signal for DMI is a basic crossover signal. So when the red line crosses over the green, then that's a sell signal. When the green line crosses over the red, that would be a buy signal. And as you can see, that you can generate quite a few signals this way, most of which are not very effective. However, I'm going to share with you a little tip that will help filter out a lot of your bad signals that you will receive trading this way. So first and foremost, the important thing to look for is that DMI is actually trading above the 25% region. So long as the crossovers are occurring down here, you're very likely going to see nothing but a market that is chopping sideways. And as you can see from this chart here, that's exactly what happened. As DMI and ADX were all hovering down below here, the market was doing nothing but ranging sideways. Now, what I actually like to do is, even though this doesn't look like it's a very tradable formation, it's actually a very good clue that the market is setting up to do something very, very soon. And so what I will do is I'll just take a look at what the basic market formation is, and I'll draw a couple trend lines on it, whether it be a triangle or whether it be a trading range or whatever the case. I'll just draw a couple of trend lines on the market, and so long as it's stuck below here, I know that it's ranging, and I know that it's safest to stay out until the market actually breaks out of this sideways pattern, which you can see happened right here. Alright, so what is this filter that we can use to make DMI and ADX a little bit more effective? Well, quite simply, when we get a crossover and the bulls or the bears take control of the market, and whichever line is on top shows the dominant force in the market at this point in time. So here, the green line crossed over the red, so the bulls are exhibiting dominance. But they do not exhibit their dominance until they actually trade above the previous peak. Notice this. The bulls actually exhibited dominance over the bears when they took out the high of the previous peak. That alone is a very excellent filter for determining who actually has control of the market given DMI. Now notice too, when this crossover occurred and the bulls finally took control by trading higher than the previous peak that the bears had formed, ADX was also on a very sharp incline. Even though it had not yet traded above the 25% region, it was still a very good indication that there was some serious momentum building to the upside, and that perhaps we should be on the alert for a buying opportunity. Now, even though DMI and ADX are terribly slow, they are very reliable. So what we would have seen here is we saw the market breakout above our trading range, which we knew it was confined in a trading range because DMI had told us so. The bulls had made a higher peak then the bears were able to. So the green DMI was above the red DMI peak. And so now that occurred right about here. So many traders would say, well, we've already missed part of the trend, so the signal is not that reliable. Well, that's partly true, but any trader knows that it's very, very difficult to trade tops and bottoms. The most reliable trades are the ones where we're actually able to take the middle or the meaty part out of the trend. So take a look what happened shortly after we had our bullish DMI peak. Yes, that's right. The market started to consolidate ever so slightly, and it started showing us our support bars, which are our red-green bar combinations. And whether you traded the first signal or the second signal or even the third signal or even the fourth signal, you still had lots of opportunities to get in and capture a very nice rally. Now this will happen time and again. If you're simply on the lookout for who has control of the market, whether the bulls or the bears, and whether the new peak, the new momentum exceeds the previous one, you'll find yourself on the right side of most of your trades. And what you're looking for is, once you know who controls the market, you're just on the lookout for an opportunity to get back into the market. And whether that's a retracement back to the moving average line, or perhaps a retracement back to a trend line, or just quite simply just our support or resistance combinations, the red-green bar combos or the green-red bar combos, whatever the case may be. But that is one way that you can use DMI and ADX to help you determine whether there is a trend coming in the market and on which side of the market you want to be, either long or short, and even when it's best to avoid the market altogether. So as I said, you can trade perfectly fine without DMI and ADX, but it can also be a very helpful indicator. So if you're having trouble deciphering when the market is trending or when a trend is coming, you might want to take a look at DMI and ADX and just play with it a little bit. Paper trade it, see how it works out for you. Like I said, every once in a while, I'll pull it off the shelf and dust it off and just run it through my market assortment, and it can be a very helpful filtering tool. And that's this week's Tricks of the Trade.